Hi, and welcome to the second quarter of Anatomy of a Recession, what to look for, and where we're headed. My name is Jeff Schulze, the investment strategist with ClearBridge Investments. Now, it's hard to believe that we're in the 10th year of this economic cycle. This seems to be the economic cycle that goes on forever. But in any long economic cycle or long market cycle, you have what we call in the industry the wall of worry. Things that could happen. Most investors are preoccupied on them, and it keeps them out of the market, but the market continues to churn higher. And while looking at this list of possibilities, I'm sure you've been concerned about some of these risks here recently. But this is where the average investor starts to get it wrong. They fail to account for the difference between possibilities and probabilities. Now, although all of these are certainly possibilities of hurting the market's performance, the probability suggests that this market cycle, that this economic cycle is going to continue to move forward. But just for fun, we went out and looked at all of the scary events of the market, and we've overlaid them on a chart of the S&P 500. And we've labeled each one of these scary events as panic attacks. So I'm not sure if any one of you listening have ever had a panic attack before, but if you have, you recognize that a panic attack comes out of nowhere. And right at that point of maximum discomfort, when you just can't take it anymore, the panic attack goes away as quickly as it came on. And there's an important parallel here to investing. So when the average investor is going through one of these panic attacks, whether it's the trade war escalation that we're seeing today, maybe the Brexit scare that we had back in 2016, right at that point of maximum discomfort, when they just can't take it anymore, they end up selling, and of course the market recovers, and when they feel good about things, they rinse, wash, and repeat the process all over. And I think Albert Einstein summed up that panic attack mentality best with a quote at the bottom of the page. The definition of insanity is doing the same thing over and over again and expecting a different result. But just for fun, we went out and looked at all of the 30-year annualized returns of every major asset class from 1987 to 2016. As you can see all the way to the left, U.S. stocks did the best at 10.2% annualized. If you look all the way to the right, you can see that the average investor fared the worst. They only garnered a 2.6% return over that time frame. As you can see right to the left of it, they didn't even keep up with inflation. Now think about that for a second. Through one of the biggest bull markets in U.S. history for not only stocks but bonds as well, so really a can't-miss environment, the average investor today has less purchasing power than they did when we started this epic run over 30 years ago. And a big reason for this is because they can't tell the difference between the noise and the signal. These panic attacks that you see on this slide, everything that you hear day in and day out from the news, that's just noise. But the signal's much more clear. The signal is whether or not we're going into a recession. Because recessions and market crashes, they tend to coincide with one another. So everybody knows what a recession is. It's a drop of GDP for 2 consecutive quarters. But what exactly is a market crash? There really isn't a textbook definition for the term. Well, to start, we can define a bear market. A bear market is a decline of the S&P 500 of 20% or more. But that begs the question, is every bear market a market crash? And we'd make the argument at ClearBridge that if it lasts less than a year, probably not. And the example we like to give is back in 2011. So if you think back 7 years ago, 2011 was a pretty scary year for the markets. Everybody was scared of that double-dip recession, similar to what we saw in the 1930s. The U.S. debt had gotten downgraded that year. Greece was going to break apart the European Union. And from April in 2011 through October, the market did lose 20% of its value. But if an investor just stayed the course for 3 more months, by January of 2012, the market was reaching new highs. So in order to be called a market crash or to be worthy of that designation, you need to see a little bit of persistence or duration to that downturn. So let's define a market crash as a bear market that lasts longer than a year. And by that definition, over the course of the entire chart that you see in front of you, so roughly the last 40 years, there's only been one market crash that did not coincide with a recession. It happened between 1987 and 1988. So there's a very famous market event that happened between those 2 years. And if you're not familiar with it, it was Black Monday. On Black Monday, which was October 19, 1987, the market lost 22.6% of its value in one single trading day. It was the only single-day bear market that we have on record. So it got us thinking, how often do these one-day crashes happen? And the second largest one-day crash in U.S. history happened 58 years earlier during the Great Depression in 1929. The market only lost 12% of its value that day, so it's a far cry from the 22% that we saw on Black Monday. So if these one-day crashes happen every 58 years, that means that the next one's not due up until 2045. So what I'm trying to get at here is that if we treat Black Monday's crash as an outlier because of A, how big the drop was on Black Monday, but B, how often these one-day crashes happen, we're left with 3 market crashes and 1 near crash, all coinciding with the last 4 recessions. Market crashes and recessions go together. The good news for everybody watching this is that we think the odds of a recession is about 10% right now for the next 12 months. So that market crash that everybody's so scared of is probably going to have to wait a little bit longer. But how do we get to that number, 10% probability of a recession? Well, first off, you need to look at what type of inflationary environment you're in because it's going to highly affect the length of your recovery. So what we're looking at here is every U.S. recovery or expansion since 1960. The average expansion has been 27 quarters long. But if you strip out those 2 high inflationary periods of the 70s, the average low inflationary periods were a little bit longer. They were 33 quarters apiece. And the reason why we're doing that, we want to compare apples to apples. We're in a low inflationary environment, so we want to look at other low inflationary environments. Now, I'm sure all of you would be surprised to know that we just hit that average in the 3rd quarter of last year. So we're just barely above the average. But if you think about what the average is the average. Some of these recoveries are longer. Some of these recoveries are shorter. And if you think about how much central bank accommodation we have and the fact that fiscal stimulus is making its way into the market, we'd make the argument that we're going to make it well past that average. But unfortunately, we need more information than that. A pitfall that a lot of investors fall into is they find a data point that they really like, and they think it can tell them the whole story, but it rarely ever can. So a good analogy for this is if I said the word pair to everybody watching. With no other context, one listener might think it means a pair of shoes, another listener might think it means to pair an apple, a third listener might think it means to actually eat a pear. But it's only when you can put words together, or in this case data points to form a sentence, where you can more fully understand the situation. That's why we've come up with the ClearBridge Recession Risk Dashboard, a group of 12 variables that have historically foreshadowed an upcoming recession. And they look across the 4 fault lines of the economy. They look at financial stresses, because generally speaking, you'll see financial stresses before the economy rolls over. They look at inflation, which is important because that's what the Fed looks at. They look at consumer health. About 2/3 of our economy is tied to the consumer. And then last but not least, it looks at business activity. And it's a stoplight analogy. Green is good, yellow is caution, red is bad. And as you can see in the 2nd quarter, we have 11 green, 1 yellow, and 0 red, which gives us the confidence that we don't think that there's a recession on the horizon, at least not for the next 12 months. But how is this dashboard done over time? Well, we looked at the dashboard versus the last 7 recessions and what the dashboard looked like going into each one of those downturns. As you can see, it's the exact opposite situation of what we have today. We had a lot of red, a little bit of yellow, and virtually no green. So that's why we feel good about the fact that the recovery will continue. But a question I usually get from listeners is, doesn't the market move before the actual recession? So what good is this dashboard if the market's already down 20, 25%, but you can tell me that we're going into a recession? Well, we actually looked at this dashboard versus the market peak for all of these recessions. And on average, the dashboard has turned yellow right before that market peak. And on average, the dashboard has turned red right after that market peak. But whether you're looking at it from a yellow or red perspective, the dashboard has historically saved you about 25% from the eventual bottom of the market. So this dashboard can be a very good tool for you to use in order to look at your portfolios and maybe take a little bit of risk off the table. Most listeners think that this is going to be an overnight phenomenon, meaning it goes from green to yellow, yellow to red over the course of a couple months. But let's look at 2006 through 2009 to see how the dashboard evolved, and you're going to recognize that it takes a lot longer than a couple of months for the dashboard to turn red. So as you can see in 2006, the overall dashboard signal was green. You have a mostly green dashboard, a couple of yellows, 2 red. As you move into the later part of 2006, the overall signal of the dashboard turns yellow, and then in 3rd quarter of 2007, the dashboard turned red, and never turned back. So generally speaking, depending on which downturn that we're looking at, it'll usually evolve over the course of 12 to 30 months, so 1 year to 2.5 years. So this will give you ample time to be able to look at your portfolios and maybe take a little bit of risk off the table should it warrant it and the economy is about to turn. I'm not going to go through all 12 of these on the call here today, but I'm going to go through 2 that we think are very effective. Now, the first one is building permits. As you can see, building permits have dove down aggressively before each and every recession, going all the way back to the 1970s. And it usually gives you about a lead time of 2 years. And it makes sense if you think about it. So traditionally, when a builder goes out, they get a permit. They build a house, they sell that house to somebody, and then whoever buys it needs to furnish it. From actually issuing a permit to furnishing your house, it's about a 2-year window, and it makes sense why this gives us so much advanced lead time. And housing-related activities make up about 16% of our GDP. So that's a pretty big headwind or tailwind depending on what's going on in the sector. The good news, if you look all the way to the right of the chart, building permits are still moving higher, and we think they're going to go higher from here because just to keep up with population growth and demolitions, we need 1.4 million units, and we still haven't hit that level yet. Also, if you think about housing, there's a lot of positive tailwinds for the industry, broadly speaking. Even though interest rates have risen, affordability is as good as it has been over the last couple of decades. Also, banks have dealt with Dodd-Frank. They've delevered, and they're finally in a position to lend to consumers that have been locked out of the housing market. And last but not least, I think millennials will want everything that every other generation has wanted before them. It's just taken them a little bit of time to get there because of student loan debt and because of the crisis. But if you think about the oldest millennials, they're in their mid-30s, the years where they're going to go get married, have kids, want the house with the white picket fence and the good school system. And if you look at millennial buying trends, they're firmly in an upswing. And we think that that's going to continue over the next 5 to 10 years. But nonetheless, as an indicator, building permits are still flashing green. The next indicator that we want to look at is the yield curve. The yield curve has successfully predicted 7 out of the past 7 recessions going all the way back to the 1960s. So it's 100% accurate. So what exactly is the yield curve? All the yield curve is, it's the difference in yield that you get on a 10-year treasury, or long-term money, minus the yield that you get on the Fed funds rate, or short-term money. In normal economic times, the yield curve is positive. You get more yield on that 10-year treasury than you are on the 3-month T-bill. Right before recession, it inverts. You're getting more yield on that 3-month T-bill than you are on the 10-year treasury. And one of the reasons why this causes a recession is because banks will typically borrow short at that 3-month T-bill, and they'll lend it long to consumers and businesses at that 10-year treasury rate. The difference in yields is their net interest margins or their profits. So when you have an inverted yield curve, there's less incentive for banks to lend, you see a contraction of the supply of credit, and a recession ensues, generally speaking, about 1 year thereafter. Now, although the yield curve has been flattening, we're nowhere close to an inverted yield curve. At the moment, the yield curve is just under 100 basis points, which means that the banking system should continue to operate in a normal fashion. But if you're going to make a call on the economy, there's one other thing that you need to take into consideration, is the consumer. Consumer spending in the U.S. is about 70% of our economic activity. And just to put in perspective how big consumer spending is, it's as big as the next 4 largest countries combined by over $1 trillion. So it's absolutely massive. And from all the metrics that we look at ClearBridge, we'd make the argument that the consumer is in the best shape they've been in post-crisis. So you have record job openings. In fact, you have more job openings right now than people that are unemployed, which means that people who have left the workforce have ample opportunity to come back in and get gainful employment. And if you look at last month's employment numbers, you had 500,000 people come off the sidelines and back into the workforce. And we do think that this is a trend that will continue over the next 12 to 18 months. You also have record quits, which means people finally feel good enough about their job prospects to go out there and get that pay raise that they've been foregoing since the great financial crisis. People are paying almost record lows, to service their debt. And last but not least, household net worth is up almost 50% from 2007, so pre-crisis. Now, if you put all of that together, we're not here to tell you that we have a consumer that's ready to go gangbusters and we're going to get 5, 6, 7% economic growth anytime soon. But what we are saying is we have a consumer that's in a healthy enough position to continue spending as they have this entire cycle. So let's put all of this together. Why are we talking about this? We're talking about this because we're trying to figure out whether or not we're going into a recession. Because recessions and market crashes, they coincide with one another. And because of the health of the consumer and because of the ClearBridge dashboard, we think the odds of a recession are extremely low. So we're positive on the next 12 months. We think that the economy will see 3.5% GDP growth coupled with a market that sees high single-digit returns from here. So we do think that the market will move higher. But when people talk about this being a different type of recovery, they're absolutely right. It just feels different. You haven't had that V-shaped recovery that you typically see, and this slide is a proof of that. So the blue line at the bottom is our current expansion, and the 7 lines above that are the 7 previous economic cycles. Now, although this has been a long economic cycle as far as time is concerned, it hasn't been a very strong economic cycle as far as growth is concerned. We're still way below the average rebound in GDP growth. So being a slow growth environment, it cuts 2 ways. The downside is people have been frustrated. Businesses have been frustrated because you really haven't seen that acceleration. But the upside is that if there's no boom, there doesn't necessarily have to be that corresponding bust to go along with it. And I think when all is said and done, that this will be the longest economic cycle in U.S. history. And believe it or not, if we make it to June of next year, this will be the longest, eclipsing the 1990s. And that is our expectation. But there's also other areas that are saying that this expansion will continue. One indicator that we like to look at is called the Conference Board LEI Index. LEI stands for Leading Economic Indicator. It's a group of 10 variables that tend to move before the actual economy. But as you can see, the LEI goes below 0% before each of the last 3 recessions. Now, if you look all the way to the right of the screen, you can see that the LEI is still moving higher, which means we're at least 12 or 18 months away from a potential recession. So we do think the U.S. economy is going to continue to chug along. But the market may be close to an inflection point. But we think this is going to be a good opportunity for investors because typically during midterm election years, the market goes nowhere until October. And once there's some visibility on what's likely to transpire with the elections, the market moves higher and doesn't move back. So although the third quarter tends to be more volatile historically speaking, we think as we get closer and closer to October, the market will melt higher because we have a strengthening U.S. economy, strong earnings growth, and let's not forget, great top-line revenue growth. In fact, once you get through the election, if we go all the way back to 1946, so 18 midterm election years, once you get through the elections, the market has not seen a negative return over that following year. And the one-year return, on average, has been 15%. And again, with that strong backdrop that we have, we think that this time around we'll have the same type of experience for investors. So we're positive on the U.S., but we're also positive on the international space. Just to have some evidence of how synchronized the growth we're seeing outside of the U.S., we are looking at the number of countries in a recession in a given year. And if you look at IMF forecast for 2019, they forecast to only have 5 countries in a recession that year, which will be the lowest number of countries in the world ever in a recession. And they're 5 very small, uneconomically important countries. So people underestimate how strong this global growth has been. But we also put together the international roadmap that shows you areas that we're positive in and we think have an opportunity for relative outperformance. We really like Europe ex-UK. Europe is unloved and hated at this point from an investor standpoint, and they stand to benefit if you see a pickup of global growth, which could very likely be a scenario if China decides to ease in light of the ensuing trade war and their deleveraging efforts. And then also we like Asia ex-Japan. But nonetheless, international has underperformed the U.S. for quite some time. We think it may be time to look at your international exposure as an opportunity to add some alpha to your portfolios. And we'll talk a little bit about that further in the presentation. But that doesn't mean that there aren't things that aren't going to drive the market. We've highlighted 8 that we think could drive the market narrative into 2019. You have Trump's presidential agenda, earnings, the international space, interest rates, oil, Bitcoin, debt, and when we say debt, it's student, auto, corporate, and last but not least, sovereign debt, and then last but not least, valuations. So let's look into each one of these themes to see if there's something to be nervous about. So let's start off with Trump's presidential agenda. Now, when Donald Trump was elected in 2016, there's a lot of investors that thought we were going to go into a recession. And it didn't matter whether you were a Trump supporter or a Clinton supporter, They thought we were going to go into a recession because the economic cycle closely mirrors the presidential cycle. As you can see here, most recessions happen in either year 1 of a presidential cycle or year 4. And it makes sense if you think about it. During the first year of a presidency, particularly a new presidency, it's dominated by the appointment of key cabinet members, congressional approvals, and perhaps most importantly, the development and often passage of a new plan that the candidate ran on, which is including fiscal stimulus. Now, all this takes time, and while this is developing, the fiscal stimulus from the previous administration runs out, and you end up having a recession. And let's not forget, if you're a president, it's always good to have that recession in year 1 of your presidency, because by year 4, when it's time for re-election, voters forget what happened 3 years earlier. But now we're in the sweet spot. Now we're in year 2 of Trump's presidency, the years where you've historically not seen a recession. And we had fiscal stimulus move through the system, and it's actually moving through the system right now. Let's not forget that we had tax reform passed in December of last year, and that fiscal stimulus is just starting to move through the system today. And we think we're going to see an acceleration of growth over the next 12 months. And the earliest that will likely see a recession is probably going to be year 4, which will be 2020 in this presidential cycle. But during midterm elections, you usually have a pretty big market drawdown. So looking back to 1962, during the midterm election years, the average correction that you've seen is 19%. Historically, these years are higher volatility than the other 3 preceding years from the previous slide. But the key takeaway here is once you get through that correction, the average recovery 12 months later is 31%. And with the backdrop of a strengthening U.S. economy, solid earnings and revenue growth, we think that this is going to be the case this time around. But one aspect of the tax plan that we really like from a market perspective is in relation to repatriation. U.S. companies have unremitted foreign earnings of $2.6 trillion locked up abroad. Since we switched tax systems from a worldwide tax system to a territorial tax system, all of those earnings have to come home. And we estimate that there's over $1.2 trillion worth of cash. And most of that money is located in 2 sectors in particular. Healthcare has almost 20% of their market value locked up abroad, and information technology. As that money comes home, that money can be used for very shareholder-friendly activities. For instance, you can increase your dividends, which makes your stocks more attractive to income-oriented investors. You could use that money for capital expenditures. That could help you be more productive or maybe take market share from your competitors. You could do share buybacks, or you could do M&A activity. So we think healthcare and information technology are going to benefit from this money coming back home. One area that we're very excited about is healthcare, because if you look at biotech today, it's trading at multiples that are less than the market. This is the first time in history that that's the case. And with big pharma bringing a lot of this cash back home, a lot of their drugs are coming up to their cliff as far as patents are concerned. We think that's a very ripe environment for M&A activity. And if you look at the first half of 2018, this has been one of the strongest years for M&A activity in the history of healthcare. And we think that that trend continues over the next 12 months. The one thing that investors are concerned about right now are the threat of trade wars. And the Trump administration is trying to level the playing field with our biggest trading partners. And there's a good reason why. So per the World Bank statistics, the average U.S. tariff is well below that of all of our trading partners. It's 3.6%. You can see that the average tariff in the European Union is 4.4%. China is 10%. So the goal here of the administration is to level the playing field. We think that a trade war will not ensue. It's not to say that tariffs aren't going to move forward, but the worst case scenario we think will not be reached, and calmer heads will prevail and new trade agreements will be forged. But if the worst case scenario happens, it shouldn't affect the economy. So what we've looked at here is all of the tariffs that have been currently proposed. If all of those tariffs go into place and all of our trading partners put in a retaliation for the same amount of tariffs, total tariffs levied in that situation is $138 billion. Now, this is a large number in and of itself, but it pales in comparison to the fiscal stimulus that we're going to see in 2018 alone. So through tax cuts for individuals and corporations, we're going to see an extra $200 billion come into the economy. Through higher spending, it's another $100 billion in earnings into the economy this year. And through repatriation, which is what we just talked about, we're going to see another $500 billion come into the economy. And that may prove to be a conservative number. If you look at the Fed's estimates of how much money was repatriated back to the U.S. in Q1, they estimated $296 billion. So $500 billion may be a conservative number. But if you take all of those together, total stimulus entering into the economy this year is $800 billion versus a worst-case scenario of $138 billion. So we think this is going to overwhelm any potential tariffs that come into play, but we do think it's going to be a ripe environment for active managers who know their companies, know where their revenue sources are, and most importantly, know where their supply chains originate from. And if we do think that trade wars are going to be dialed up here, active managers can be able to sidestep some of the carnage that may happen because of margin compression and an escalation of tariffs. But we don't believe that the worst-case scenario will be realized, but even if it is, the economy should continue to be able to move forward. So let's move over to earnings. Now, earnings in the U.S. have been very robust. If you look at first quarter earnings, they were up 26% year over year. It would be a mistake to say that this was just tax reform. So if you strip out the one-time effects of tax reform, earnings in the first quarter were still up 18%, but more importantly, revenues, which have been the one thing missing from this recovery, were up 8%. So those two numbers are some of the best that we've printed since 2008. But there's a really easy way to be able to tell whether or not earnings are going to go higher or lower from here. And that's by looking at manufacturing PMI. So manufacturing PMI is a survey that's given to manufacturers, asking them how business conditions are, but also how business conditions look to be in the future. And it has a lead time over earnings per share of the S&P 500 by 6 months. So as you can see, there's a very close correlation between the two. And if you were looking at manufacturing PMI back in 2015, people were concerned that we were going into a recession that year, but manufacturing PMI bottomed in December of 2015. Sure enough, 6 months later, we're out of the earnings recession, the market and the economy were moving higher, and it never looked back. So the most recent print that we had on manufacturing PMI was 60.2. Anything over 50 is considered expansionary. 60.2 is close to cycle highs that we've seen, which means even though earnings have been beating as far as expectations are concerned, we should continue to see stellar earnings for at least the next 2 or 3 quarters. But when you talk about earnings, you also need to talk about share buybacks. Share buybacks have arguably been one of the most important drivers of equity performance really since 2002. And this chart is the proof piece for that. So the red line at the top is the S&P 500. Below it, you have buybacks and dividends. And as you can see, they're almost mirror images of one another. Just to put in perspective how important share buybacks are. In 2016, total share buybacks in the market totaled $550 billion. All of the money that went into active and passive investments during that year were $175 billion. So corporations, through buybacks, were 3 times the size of buyers of equities than all investors combined. Now, one of our fears at ClearBridge is if we didn't get tax reform, buybacks would dry up in 2018, and we potentially could have some higher volatility and some negative price action in the market. The good news, obviously, with repatriation happening as we speak, we think that this year will be the biggest year in stock market history for share buybacks, totaling over $800 billion. So that biggest buyer of the market, that indiscriminate buyer, that put or that floor continues to be in place. But when you have these higher earnings years in the market like we're going through right now, typically it's a better market environment for you. So since 1950, when you've had 10% earnings growth or greater, the average market return has been 11.3%. All other years, when you didn't hit that bogey, it's 7%. And with first quarter earnings up 26% year over year, we think we're easily going to hit that 10% bogey and that the market should continue to rise higher as we move throughout the year. Let's move over to the international space. Now, when people talk about the international space, there's really 2 regions that come to mind, China and Europe. So let's look at both of them a little bit deeper. I'm going to give you the bull and the bear case for China. The slide that we're looking at here is the bull case. Everybody knows that China has a lot of people. Let's put that number of people in perspective. So China has 415 million millennials. That's 100 million more millennials than Western Europe, the U.S., and Canada combined. And it's an educated demographic. And again, they're millennials. The oldest millennials are in their mid-30s, the years where they're going to spend the most amount of money that they've ever spent before. So in order to be in front of this demographic wave, you want to buy companies that make something that you eat, wash, drink, wear, or shop. We like consumer staple, consumer discretionary, and also IT companies, the quote-unquote new economy over in China. Just a quick trivia question, just to put in perspective how big China is compared to the U.S. The U.S. has 10 cities with over 1 million people. China has 160 cities with over 1 million people. So we like China from a new economy perspective. We think there's going to be ample opportunity as these millennials mature through their life cycle. That's the bull case. But let's look at the bear case. Everybody knows that China has a lot of debt. Let's put that debt in perspective. So what we're looking at here is bank loans in China, or corporate debt. And as you can see, since 2012, corporate loans are up over 100% of GDP in China. Now, I know that number doesn't mean a lot to the listeners. Let's put a little bit of context to it. China has increased their bank loans the size of Canada each and every year since 2012. 2012, Canadian GDP. 2013, Canadian GDP, and so forth. And just to put it in perspective, Canada is the 10th largest country in the world, so it's not a very small country. And throughout this time frame, all of this increased debt, you've seen growth levels come down significantly. So what that tells us at ClearBridge is a lot of this money is reaching insolvent borrowers or zombie companies, a lot of the state-owned enterprises that were set up in cyclical areas of the economy. The good news is that leadership is now purging a lot of that excess capacity. Now, the key question for investors is whether or not that purging, the cleaning up of their financial system, is going to create a hard landing or a soft landing. We at ClearBridge are believers that a soft landing is in the cards for China, but nonetheless, even if you have a hard landing, we don't think it's going to cause a recession in the U.S. Because although China exports a lot to the U.S. does not export a lot to China. Less than 1% of our GDP is into exports. So if you have a hard landing, it certainly will cause financial volatility in the U.S. You could see the markets down 10, 20, 25% fairly quickly. But if there's no recession, there's no market crash, that rebound should be very much bought, and you could see the market higher very quickly thereafter. But you want to have exposure to China because that's one of the only regions of the world that continue to grow. In 2000, China was only 4% of the world's GDP. In 16 short years, they've been able to grow their piece of the pie up to 15% of GDP. And although growth levels have come down, they're still growing well above the U.S., twice as fast, in fact, as the U.S. So you want to have exposure to this region of the world, and most investors are woefully underweight Chinese equities. So that's China's story. We think it's going to be a soft landing. We think China represents some very good opportunities from a new economy perspective. Let's look at Europe. European GDP has been growing faster than the U.S. for the last couple of years, but that wasn't always the case. Big reason is because of central bank policy. So the U.S. has one central bank, the Federal Reserve, and they have one country that they oversee. So coming out of 2008, we were able to get liquidity into the system very quickly through QE programs. Europe did not have that luxury. They have one central bank. However, they have over 20 countries trying to go under that monetary policy. And because it took them a long time to figure it out, they had a recession in 2011 while the U.S. continued to grow. But ever since Draghi's do whatever it takes speech, liquidity has entered into the European financial system and filtered through to higher economic growth. Now, although you can see the U.S. outperforming Europe in the last quarter, and that may continue for the next couple of quarters, the equity markets may be a different story for a number of different reasons. First off, Europe is in the earlier part of their economic cycle. They're in the fourth inning, while the U.S. may be in the seventh inning, so there's higher absolute growth. Also, if you look at Europe, their unemployment rate is closer to its long-term average rather than its prior trough levels. That's certainly not the case here in the U.S. If you look at European profitability, they're the only region in the world where earnings per share is not close to an all-time high, and in fact, it's about 15% lower than a decade ago. So their corporations can be a little bit more profitable, which would be reflected in higher equity prices. Valuations remain attractive right now, and you're also starting to see that slowdown that's materialized there turn the corner. Manufacturing PMI is starting to grind higher, and also the Citigroup Economic Surprise Index, better known as the CESI, had a very negative print of negative 90. Whenever it hits these levels, usually you see mean reversion, which means better economic growth lies ahead. And last but not least, you have monetary policy over in Europe that's still extremely accommodative. They're still doing things like quantitative easing, negative interest rates, while we're doing balance sheet normalization and we're normalizing the Fed fund rate. So because of all of these dynamics, we think Europe is a very good opportunity for investors for relative outperformance. But when the U.S. and the international space go head-to-head, outperformance is very cyclical, just like any other part of the market. When one leads the other, it usually happens for a period of anywhere from 3 to 10 years. So if you look at the top right-hand slide of the slide, the U.S. has outperformed for the last 10 years, and it's outperformed by 115%. We think we may be close to that inflection point where the pendulum swings back to the other side. And if you look at the last 6 economic cycles that we've had here in the U.S., 5 out of 6 of those cycles, at the very end of them, international outperformed the U.S. And I think this may be very well the case as we move into the later parts of our economic cycle in the next couple of years. Let's look at interest rates. We think interest rates are going to go higher on the long end of the curve for a host of different reasons. First off, we think growth is bound to accelerate, and we think that we're probably going to get a 4% GDP print this quarter and potentially even Q3 and Q4 of this year. That usually reflects in higher long-term bond rates. We think inflation is slowly going to move higher towards a core PCE number, or core personal consumption expenditure number, of 2.5% by the end of next year. Investors are going to start to want compensation for that higher inflation picture. But also, you're going to see higher supply of treasuries coming online. Now, from 2018 versus 2017, you've seen a 57% increase of treasury issuance. A lot of that issuance so far has been on the short end of the curve, but there's only so long that you can do that. Sooner or later, you're going to have to start issuing some more longer-term debt, and a lot of that's going to be at the 10-year rate. So whenever you have more supply of anything and less demand, there's going to be an equalizer that creates more demand, and we think that that's going to be through higher treasury yields. And as you can see in 2019 and 20, and for the foreseeable future, you're going to have borrowing surging to over $1 trillion per year, and that's going to continue into the 2020s. But international investors have reason to stay home versus come over to buy U.S. Treasuries. If you look at it from a hedge perspective, meaning you take out the dollar exposure, U.S. Treasuries are no longer attractive to European investors. So back in 2014 and 15, when the ECB introduced negative interest rates, it was very attractive for Europeans to buy U.S. Treasuries. Your yield pickup was over 1% when you took hedging costs into consideration, but that has evaporated, and now you get a negative yield pickup if you come across to the U.S. to buy Treasuries and you're a European investor. So because of the increased cost of hedging, we think the demand for U.S. Treasuries is going to be lower than it has been in the past, and that's going to be another reason why rates continue to grind higher from here. It wouldn't be a surprise for us to see a 10-year Treasury in the 3.2 to 3.5% range over the course of the next 18 months. So we think it's going to grind higher over the course of the next couple of years. But we also think that European investors are going to stay home because yields are going to be more attractive in the near future. Just to put in perspective how much of a distortion the European Central Bank has had in their markets, we can look at European high yield versus the 10-year Treasury yield here in the U.S. As you can see, they're yielding the same amount. That is a distortion. You have the junkiest companies in Europe that are paying the same amount to borrow as the world's risk-free rate. The reason for this is that the European Central Bank has had much more of an outsized effect in their markets than the U.S. did during any iteration of QE. Per Deutsche Bank, in 2017, the European Central Bank bought 7 times the net issuance of bonds in the Eurozone, and not at one point did the U.S. buy all of the issuance that the Treasury is putting out at any iteration of QE. So now that the European Central Bank is close to normalization, they're starting to taper their QE. That's going to be done by the end of the year, and they're going to start to increase rates by the middle of 2019. We think that there's a lot of room to rise for not only European high yield, but also sovereigns and corporates. And it's going to be felt from a global investor standpoint much more so than it has in the past. Global duration has gone up over 40% from its lows that we saw back in 2009 from 9 years all the way up to 13.5 years.
So as rates normalize and continue to move up, not only in the U.S., but also in regions like Europe, that investors that have fixed income exposure are going to feel that much more acutely, and that could cause a mini rotation out of fixed income and into equities because of that increased interest rate sensitivity. But nonetheless, we do think that global yields are poised to rise as we move further along in this economic cycle. So let's talk about oil. So oil has been moving up over the past couple of years, and if you were looking at a certain measure of oil, you would have seen this coming. So you can tell whether or not oil is likely to move higher or lower based on supply and demand, whether or not there's a deficit, meaning demand is outstripping supply, or there's a surplus, meaning more supply than demand. And if you look at that purple line, that's crude oil, and it remained elevated really since 2010 through 2014 because you had a persistent deficit. But because of the shale revolution and all the supply coming on, pumping at all costs, that brought on a tremendous amount of supply, which overwhelmed the fundamentals and caused oil prices to drop dramatically to a low below $30 a barrel back in 2016. So we've worked off that supply over the last couple of years, and we're in a deficit situation, and not surprising, we've seen the price of a barrel of oil move up to $70 a barrel, and we think oil is likely to remain at these levels or potentially move higher as we move later and later in this economic cycle. Because the consumer has a lot of stimulus from tax cuts. The estimated boost to consumers from that tax cut is $120 billion. Now, although retail gasoline prices are up 12% year over year from what we paid at the pump in 2017, we wouldn't see an erosion of all of that tax cut until a barrel of oil hit $86. Now, as we speak today, we're in the mid-60s, so that would mean energy prices would have to rise substantially before it erode away all of the benefit that consumers have from the tax cut. A big reason why people are concerned about rising energy costs is that if the consumer is spending more at the pump or more to heat their houses, there's less discretionary income to enter into the economy, and we are in the rare instance where we have enough fiscal stimulus to offset the increase in gasoline prices. We do think there's an opportunity with energy stocks. There's usually a close correlation between the price of a barrel of oil and energy's relative performance to the S&P 500, but you had a divergence back in 2016 where the price of a barrel of oil went higher and energy's relative performance didn't follow it higher as well. So we think that there's an opportunity for catch-up there because valuations are very low at this point. From a price-to-book perspective, energy stocks are trading at one of the lowest levels that we've seen over the past 20 years. Also, you're seeing signs of capital discipline from U.S. exploration and production companies. They're not pumping at all costs. They're actually trying to be profitable, which is a very big difference from where we were a couple of years ago. You're also seeing bottlenecks in places like the Permian. You have Iranian sanctions that could potentially come online, maybe some geopolitical risks that should be priced into a barrel of oil. Positioning is light. There's a lot of reasons why we think oil prices can continue to go higher and that energy stocks have an opportunity to catch up to the price of a barrel of oil. But this wouldn't be out of context from an energy perspective. Energy has outperformed on a relative basis to the market at the end of every one of the economic cycles that we've seen, going all the way back to the 1960s. So that's 7 economic cycles. And I think that the move that we've seen so far here in 2018 is the beginning of a bigger move higher for energy stocks on a relative basis. So we're very positive on energy as a sector and MLPs as a industry group because MLPs have taken quite a big dip here over the last 3 years, and they haven't nearly recovered as what we think the fundamentals would suggest. Let's talk about Bitcoin. I'm going to give you both sides of the coin, if you will. Let's talk about the bull case for Bitcoin. So the Bitcoin bulls will say that Bitcoin's only $100 billion in market capitalization. If it ever gets widespread adoption, it could be as much as other large monetary assets that are outstanding. So if you look at the U.S. monetary base, that's almost $4 trillion. All the gold ever mined in the world is close to $8 trillion. The U.S. stock market is $28 trillion. So if you ever get mainstream adoption, Bitcoin could be multiples and multiples higher from where it stands today. Now, that's a very compelling case. But I think the bear case may be a little bit more compelling. Let's look at Bitcoin and its price action since 2017 versus all the major bubbles that we've seen in the past 50 years. So we're comparing it against the NASDAQ bubble, the Japanese bubble, gold's rise in the 2000s, and the housing bubble. And in 2017 to today alone, Bitcoin absolutely trounced all of those major bubbles. We actually wanted to go back to 2013 and show you Bitcoin's rise, but if we would have made that graph, it would have looked silly for you. So since 2013, you could have bought a Bitcoin in January that year at $13. As of mid-year, June 30th of 2018, your increase in value would have been 48,000%. If you put that a different way, you would have got 480 times your money in a 4.5-year time frame. You just don't see price action like that outside of bubbles. So we don't like it from a price perspective. But there's another reason why we don't like Bitcoin. Why is Bitcoin going to win the cryptocurrency game? There's another 10 cryptocurrencies that are out there. So why is Bitcoin going to be the winner versus these other competitors? And the last reason why Bitcoin potentially could go down a lot from here is that even if the bull case comes to fruition, what does the government like to do most? They like to tax. And if you have a currency that's outside of their taxing purview, they're going to try to regulate it. And if they can't regulate it, they're going to outright ban it. So even if that bull case comes true, I think that the bear case of government regulation and or outlawing of Bitcoin use is potentially a negative that would overwhelm that bull case. So the bull case on Bitcoin is very compelling, but I just think the bear case is a little bit more compelling at these levels. Now let's move over to debt. We're going to look at debt from a number of different facets. We're going to look at student debt. We're going to look at auto debt. We're going to look at corporate debt, and last but not least, U.S. sovereign debt. So let's touch on student loans first. Now, student loans outstanding right now are about $1.4 trillion. Now, that's a big number, but 92% of that loan balance is issued or backstopped by the federal government. So if people stop paying their student loans, the federal government will be able to pick up the tab. It's not going to be a situation like we had in 2008. It's not going to be a macro issue. But also, as you can see from that second bullet point, 84% of people who have a student loan have a balance less than $50,000. Now, I think that this is a big reason why you've seen consumer spending trends down this cycle versus cycles past. But $50,000 is only enough to prevent you from maybe buying a car, buying some nice furniture for your house. But again, as we talked about, the oldest millennials are in their mid-30s, the years where they start their families, have babies, and I think that it's not going to hold them back from buying a house and buying those larger purchases that they've been foregoing for a long period of time. But nonetheless, student loans isn't going to be the next housing crisis. But what about subprime autos? Subprime auto loans have gone up significantly this cycle. To put in perspective, subprime auto loans total about $275 billion. Now, that's a big number, but it pales in comparison to subprime mortgage loans in 2008 of $1.2 trillion. So subprime autos are about 1/5 the size of subprime mortgages. But there's also a couple other key differences between the two. First off, banks are in a much better position today than they were back in 2008 from a capital perspective. Because of Dodd-Frank, they've built up their balance sheets, and even if you see all of those subprime auto loans go belly up, banks are in a much better position to handle that loss than they were 10 years ago. Also, it's easier to repo a car than it is to kick someone out of their house. That was a big issue back in 2008 because you couldn't repo that house and you couldn't recognize that loss immediately, so banks didn't know where the bodies were buried on each other's balance sheets. With a car, you can repo it very quickly, and although you may get 70 cents on the dollar for that repo, that loss is recognized immediately, and there's not any guesswork from everybody else in the banking community on whether or not that loss is going to show up in their statement. But last but not least, people are more apt to pay their auto loans than they are their mortgages. So I think there's a good reason why, even if subprime autos becomes an issue, you see widespread defaults. It's nothing more than a dislocation, especially for a couple of banks that have an outsized exposure there. Let's look at corporate debt. Now, corporations have done a very good job of terming out their debt and taking advantage of the low-rate environment that this market cycle has provided them. The average weighted maturity of S&P 500 companies is 10 years. So even though rates have risen, and we expect rates to continue to rise over the next 12 to 18 months, we're not going to hit a maturity wall where a lot of these companies aren't going to be able to service their debt and erode their profitability and have a big default cycle. They've done a very good job of pushing this out farther than most people would expect. Also, if you think about it from a debt perspective, if you look at all the non-financial corporate debt outstanding, and that includes both loans and bonds, It's about $9.1 trillion. That's up substantially from 2010 at $6 trillion. So we've seen a 50% increase of debt. But what people fail to tell you is that it's only one side of the coin. The other side of the coin is if you look at 9 financial corporations' liquid assets. That's at $2.7 trillion. So if you look at the ratio between debt at $9.1 trillion and liquid assets at $2.7 trillion, that ratio is one of the lowest readings that we've seen since the 1960s. You could say the same thing about consumer debt. Even though consumer debt's at record levels, asset values and the assets on the balance sheets for consumers have never been higher. And that ratio, again, is very low compared to history. So although corporations have taken on a lot of debt, they have a lot of assets to go along with it. We're not going to see the maturity wall and a rash of bankruptcies due to paying higher rates. Last but not least, let's talk about the U.S. and our growing debt levels. The U.S. is the only country in the world that is going to have higher debt to GDP ratio in 5 years than where we are today. A big reason for that is for the corporate tax plan that has been introduced into Congress. Now, is this going to cause a financial crisis? And the short answer is no. If you look at total debt to GDP, the U.S. has one of 205%. Now, that's a large number. But we're not close to Greece, but also there's another country in the world that has a much higher debt to GDP ratio than the U.S. that could potentially be a roadmap for our debt levels if they go a lot higher. And that country is Japan. Japan's debt to GDP ratio is 240%. So there's a lot of leeway. There's a lot more higher debt levels that we can get here in the U.S. before it's a potential issue. But there's also a key differential between the U.S. and Japan. The U.S. is the world's reserve currency. Commodities are priced in dollars. The world has arguably never been more dollarized than it is today. Outside of our borders, there's over $11 trillion in U.S. dollar denominated debt. So having the world's reserve currency gives us a lot more leeway than other countries as far as our debt levels are concerned. But let's just say we need to get rid of this debt, and eventually we will have to. There's only 3 ways to be able to do it. You either default, which the U.S. would never do because we print our own currency. You can grow your way out of it. And there may be a technology like the internet that comes along and helps us grow our way out of these debt levels, or you can inflate your way out of it. And at the end of the day, inflation is probably going to be the route that comes to take away this debt, but we're not talking about a 5 or 10-year inflation period. We're talking really 20 years out from now. So it's not a 2020 issue. This is really going to be a 2040 issue once debt levels are high enough where investors start to really get concerned about the viability of getting paid back. But nonetheless, debt levels are going to rise in the U.S., but we don't think it's going to be a near-term catalyst for any substantial sell-off. Let's talk about valuations. And before we turn to the next slide, I'm going to do a quick game with everybody watching. So since 1926, the market has had 92 years of annualized returns. Out of those 92 years, how many times do you think the market returned greater than 20%? Greater 20%, 92 years. Okay, now that you have that number, how many times out of those same 92 years do you think the market lost more than 20%? And I think the answers are going to surprise you. Now, out of the last 92 years, the market has returned 20% or more 34 times. So in any given year, you have roughly a 40% chance of getting at least 20% return on your money. Those years that everybody's so scared of, those negative 20% years, 6. So I think this chart does a very good job of showing you the risks and rewards of the market. And if you're a long-term investor, if you have a time horizon longer than 3 years, no matter what the valuation level is, the market is more your friend than it is your foe. But I think there's a lot of fear right now because we haven't had a big pullback in quite some time. Now, I define a large pullback as 15% or greater. Now, believe it or not, it's been almost 1,700 days since we've had a 15% correction. And these are trading days. If you put that a different way, it's been over 6 years since we've had a 15% correction. Now, a lot of investors think that's a long time, and they fear that we had such a great stretch of positive market performance that the next step is the abyss, and we're due for a very big pullback. But believe it or not, we've actually had 2 periods of U.S. history without a 15% correction that were longer. The 1950s, we went almost 2,100 trading days without a 15% correction. In the 1990s, we went 1,900 trading days. So just for us to get to those 2 levels, that's another 1.5 to 3 years. So these long periods of performance without a big correction can happen much longer than investors think. But when people talk about the market being expensive, what's everybody's favorite metric to use when they say that it is? Price to earnings, right? So I'm going to throw out two price to earnings numbers to everybody watching. Let me know which one that you'd rather have. Would you rather have a price to earnings of the market at 23 or a price to earnings of the market at 16? If you said 16, you actually would have given the wrong answer if we're looking at the time frame that you see in front of you. So we're looking at the PE of the market since 2003, the last 15 years. Now, if you had bought the market in June of 2007 at 16.3, it wasn't the best time to put money to work. We all know that the financial crisis happened shortly thereafter. If you had bought in June of 2009, the PE of the market was 23. It was a generational buying opportunity. So although I like PE, and I think it's a very good valuation metric, and we certainly use it for valuation at ClearBridge, it's not the end-all, be-all. It's not the holy grail of investing. You definitely want to use it in concert with a lot of other valuation metrics that are out there. But one that we found has been very helpful in identifying a top in these very long economic cycles. These economic cycles that seem to last forever involve something that includes interest rates. So instead of the PE of the market, we're looking at the EP of the market. So you just flip the P and the E around. It's called the earnings yield of the market, and it's a way to convert the market into a bond. And we looked at the three longest U.S. economic cycles and what the differential between that earnings yield of the market was versus the 10-year Treasury. So in 1968, at the end of the 60s, the spread between the two was negative 0.7. And at the end of the 1980s, so in 1990 there, the spread between the two was negative 2%. At the end of that epic run in the 1990s, the spread between the earnings yield of the market and the 10-year Treasury was negative 2.4%. Today, even with the rate rise that we've seen, the differential between the earnings yield of the market and the 10-year Treasury is positive 1.9%. So what that tells us at ClearBridge, that in order to see a major bull market top, you need to see one of two things happen. You need to see interest rates rise from here, which we do believe is going to happen, or you need to see the market get more expensive from here. And we think at the end of the day, it's going to be a combination of these two that bring the spread close to zero or maybe even negative when all is said and done. If you think about the market in bigger terms, in longer terms, it gives you a much different vantage point of where you are in this cycle. So we're looking at the market from a secular bull or secular bear perspective. All that really means is 10 to 20-year periods where the market either goes nowhere, which is a secular bear, or a 10 to 20-year period where the market goes up a lot, which is called a secular bull market. So if you look on the left-hand side of the chart, you have a secular bear market of the 30s and 40s. Total return during those 2 decades was negative 22%. Not the best time to be in the equity markets. But that secular bear market gave rise to the secular bull of the 50s and 60s, where your total return was positive 450%. That gave way to the secular bear of the 70s, where you only made 17% that decade. Again, the secular bull was born out of that of the 80s and 90s, where your total return was over 1,250%. In our opinion, we exited the secular bear of the 2000s and 2010, and we're in the middle of a 20-year period, which is a secular bull market where the market returns are above average. And this is where you want to have your equity exposure, because if history is any guide, going all the way back to the 1930s, even if we have a recession or we have pullbacks, this is where the market makes the most of its money. Last thing we want to share with you, though, is signs that you typically see at a bull market top. Different behaviors that are evidencing themselves in the marketplace. We saw all 9 of these in 2000 and 2007, and right now, we're not seeing any of them. We haven't seen a blow-off top, and the move that we've seen since 2016 was on better earnings and better global growth. It wasn't a blow-off top. It wasn't the type of market where the market kept going up and you scratch your head and you can't really put 2 and 2 together. You haven't seen heavy inflows into equities. Equities is still a relatively hated asset class, even though this is the 10th year of this recovery. You're starting to see a bit of a pickup in IPO and M&A activity, so those may be check marks as we move later into the year. You haven't seen any credit spreads widen. So until you start to see some of these behaviors being evidenced, we are still very much in the buy the dip camp for ClearBridge, and that this economic cycle and this market cycle is going to move forward. So thank you all for joining us for the Anatomy of a Recession. As a reminder, we think the odds of a recession right now are 10%, so that market crash like 2008, like 2000, is at least 12 months away from now. We think the U.S. economy is going to continue to strengthen as we move throughout 2018 and that earnings growth, although it's robust and you have had a boost because of tax reform, that's not the only thing driving corporate profitability and top-line revenue growth. So thank you again for joining in, and we hope to see you next quarter for the anatomy of a recession.